products have been coming in, both in fintech and emerging technologies. So would love to start with, asking each one of you, what global domestic trends you've seen, given that the strange times we all have been living in, and how different has it been compared to, say, maybe 3 to 5 years ago? Anil?
Thanks, Anu. Am I audible?
Yes.
Yeah. So after 9/11, the front doors of the financial institutions and banks are almost closed. And that's a reason the terrorists or the criminals have devised alternative ways through charities, hawala, smuggling, trade-based money laundering, and all are thriving through the back door. So since 2000, since 1970, there are over 100,000 plus terrorism event, which has affected the world and cost us with a lot of lives. The new approach by the terrorist again reminds us of the grave threat that it could cause. It's just not 9/11. After that, we have serious attacks and the strategies have been changed. Money continues to be lifeblood and oxygen of terrorists. And better we get at choking them, better we combat terrorism. Just like money laundering, terrorist finance is a predicate offense, and early detection and immediate counter steps are the only ways to combat it. Convergence and coalitions that becomes a force multiplier is possibly the best strategy to fight this terrorism. Of course, terrorism, like a pandemic, doesn't respect the international borders, and they've reaped the benefits during the pandemic. And there are emerging threats in different terrains, like environment crimes, where the terrorist organizations have ventured out because they have very less land to control. And there are very less resources for the finance, like ISIS was earning through agriculture, through charcoal and gold smuggling. So these are a few of the trends globally and locally as well in the international area of counterterrorism.
Great. No, that's very insightful, and that dives into how the banks are seeing this. So, Ms. Theresa, any insights from you in terms of how in the banking world, financial crime, which has been on the uptick, unfortunately, over the last several years, what regulatory practice in particular you may be seeing, and how regulators may be reacting to this in terms of to come back with a punch to nip it in the bud?
Yes, the last couple of years have been tough and particularly in the COVID times, it has been extremely tough because it has seen the emergence of financial crime. In fact, there's supposed to be around 100% jump in the crime rate, which has been triggered by the pandemic. There are various reasons for this. One is that the situation is entirely different. Say, for instance, like people looking for supplies, governments placing orders for supplies, and then they are directed to fake websites, possible channels of money laundering takes place, and money is siphoned off. In a couple of instances, which FATF has mentioned, there have been cases where it could be stopped, but with international cooperation. Now, what we have to look at, what are the new trends in terrorism which is coming up? According to a study which was done by the Center for Financial Crime in Paris, the trend is now no longer big financing, huge financing, etc. by terrorists. And the sources are now coming like it's go local. Instead of go global, it is go local. And they look at sources of finance, homegrown sources of finance, donors, emerging non-profit organizations also emerging as sources for terrorist funding. And very often, donors are not really aware of the purpose for which the funds are being utilized. So these are some of the channels which are being done. And as the speaker before mentioned, finance is the lifeblood of terrorism. You need finance for supporting your mission, carrying out your mission, for the supplies, transportation, and also for their day-to-day livelihood. So while it may be seen a little old-fashioned to say follow the money, the financial footprint across transactions, across withdrawals of money, the movement of money, and of the new virtual currency assets has been a trend which regulators and enforcement agencies are closely following. And this is where the regulators are looking for, besides putting in regulations in place with anti-money, the KYC AML in India is very stringent and takes care of most of the customer onboarding and the due diligence regarding on that. FATF has also come out with modifications to its guidelines in recommendation 15 and 16 on virtual assets, where it talks about that virtual asset service providers have to be registered in the particular country of their origin and before they are allowed to transact business. And they're also moving towards seeing that the money transfer, wire transfers, etc., are regulated in the sense that the information regarding the remitter and the beneficiary are made more transparent, which would actually choke the anonymity, or rather remove the screen of anonymity from virtual assets and pave the way for a greater transparency and to track down and the persons who have committed these crimes and the sources, the trends of financial crime, not just of terrorist financing, but other money laundering also. And so it's still follow the money, follow the financial footprint, and tougher regulations to bring about transparency in transactions.
Many valid points, Ms. Theresa, and in fact, you touched upon virtual currencies and the times we are living in right now. It's taken up a lot of newsprint, and like today only I was reading how India is the 11th most active country in the world with 6+ billion invested in crypto assets. So let me ask Ms. Manorama, given your background and how closely you may have seen this, from a financial crime standpoint, are there new challenges for banks, financial institutions, and exchanges who are dealing with crypto assets from a CFT, from an AML? And if yes, what could be done to ensure it gets streamlined without really getting shut off? But at the same time, the concerns, both supervisory and regulatory concerns regulators may have for dealing in these assets are mitigated.
Sure, no, I was hoping with the connections, that question was for me. So thank you so much for having me today. A couple of things. From my perspective, when we are talking about any global regulations, whether it is cryptocurrency or otherwise, I think we have enough of provisions already, from anti-money laundering, sixth directive, where specifically there is a specific clause on cryptocurrency and how the transactions have been monitored today. It's very clearly laid out in anti-money laundering sixth directive from EU as well. The second thing is, from a Banking Secrecy Act, we are still yet to come up to the speed and harmonize them. That's my thought. If there are any recent changes between this week and last week, I'm not aware. But cryptocurrency seems to be a tackling devil at this point of time. The reason so is because our technologies from our legacy banking systems do not, support the processing bit of it. It's not about the understanding. I think it's about implementing those changes in the banks today. A lot of the time, let's think like a chief risk officer in the banking, any XYZ banking, right? So why would I want to change my technology just for one asset, changes which is happening across the world? For me to change that as a risk officer, it covers a lot more compliance issues than actually incorporating at a large what are the scope of from a regulatory standpoint, right? So the real challenge is not from a regulatory standpoint. For me, we have enough regulatory covering from EU standpoint, where FATF, as Madam mentioned, we have more than scope and provisions which have been mentioned. From an Asia standpoint, we have Banking Secrecy Act. We also have RBI guidelines and SEBI coming up with open book approach, where all the assets have been available and beneficiary details are available right now to tackle that problem. I think the larger problem is about adopting this technology in the right time. Right. And also, do we have enough technology to support arresting the data points and the primary source where all the assets are in one place, right? I think most of the information is scattered in a multiple platforms. That makes it more harder for us to say that, hey, this is a single source of truth today where I can procure the data from or procure the information from, which is sought by the regulator or from a banking processing or a due diligence standpoint. I think this is a challenge from a cryptocurrency standpoint. Number two, also, we have a great technology in place as well. But however, as I mentioned, the change of the thought process from a legacy banking to adapting these changes over the night is going to take a long time for us to say that there is the long-term benefits for us rather than actually holding on to the legacy system. Yeah.
Very, very interesting points, Mr. Rana. In fact, and that takes me to something which I think I've always wondered and worried about is, the trends, more wondered than worried. The trends that, we may be seeing from the enforcement side in India in terms of the increasing financial crime risks for many market participants. So, Mr. Sunil, would love to hear from you, given your extensive experience in this space, in terms of dealing with the FIU. What practical challenges the banks may be dealing with. The new payment systems which are increasingly coming up, be it in the form of payment aggregators, gateways, or in future the pan-India umbrella entities. Each one of them will create newer issues around financial crime, dealing with it, maybe soft spots for rogue elements, and FATF, of course, aligning the global laws to Indian laws. So, would love to hear from you in terms of FIU key trends and anything else on this.
Yeah, thank you very much, Mr. Anu Tiwari and other panelists for that explanations and the developments recently happening on the AML and FATF space. So 2-3 things I would just mention. From an international perspective, yes, FATF principles have been well established, and there was a time actually 2-3 years back, and originally it started from 2013 onwards. Heavy penalties were seen across the world. And sometimes we felt that as US regulators are imposing heavy penalties on the European banks, and European Union is imposing heavy penalties, retaliating in one way to the US banks. So the point is that the penalties level, if you look at internationally and in India, very, very different, because there are, we can see any major bank, if you take their penalties for the last, not last, actually 3-4 years in a window, is reaching to 1 billion to 1.5 billion, like that. And there were banks even paid more. So it can actually entirely wipe out the capital of the bank. That is one of the regulatory actions internationally happening. And afterwards, I think in the international financial scene, yes, the institutions have in a very large extent implemented all the lot of systems controls, and it is getting stabilized. As compared to it in India, as penalty levels, I would say RBI is very sympathetic to that extent, and penalties are not going even beyond 5 or 10 crores to that extent. So when you compare with internationally, that is the scenario. Now, what are the challenges the financial institutions in India particularly when addressing this AML CFT related regulatory position and the challenges? The one fundamental thing, banking itself is transforming. It is now the identification, CIP, customer identification, is very easy. It is not a difficult thing because Aadhaar and the documentation is there. You can cross verify, you will get it. But knowing the customer is getting difficult, because where is the customer? The newborn customers are all actually non-face-to-face customers. Branches and the bank officer has no idea where the customer is located, from where he is doing the transaction, and what are the multiple channels he is using. So that is where the entire assessment of the knowing the customer, number one, as well as behavioral and transactional monitoring level assessment has been completely changed to that extent. It is very, very difficult nowadays to understand. And first, of course, We have technological solutions coming from the fintechs and regtechs to that extent, saying that more and more artificial intelligence being used, data analytics being used, pooling the data from everywhere and every system within the bank and doing it. Of course, when we do all these things, one connected problem, and this is one of the another international trend. One side FATF and the regulatory stand, other side the banks have also realized, and that is what it's led to the Wolfsburg principles and Wolfsburg combination of the banks. And one of the fundamental principles Wolfsburg said, whether they are giving the guidance for correspondent banking or for the trade-based money laundering, is that, look, in the AML CFT space, the banks are having only 10% of the data and the transactional information. The remaining 90% is standing outside, whether it may be in the customs office, it's with the shipper, it's with the insurer, or even the government bodies and the investigation agencies. How the banks and financial institutions to tackle that? So one of the new trends are happening is that banks are realizing to this system. And if you look at the Wolfsburg principles in the TMBL as well as correspondent bank, they're actually suggesting the alternative mechanism how these regulatory requirements can be met. So this is the second challenge, I would say. Now coming to your last point of new payment system. The new payment systems, whether it is a UPI, IMPS, or NEFT, and whether it is a BEAM or Bharat Pay, whichever is the mechanism of payment is happening, the essential data in certain areas where the traditional money laundering officer looking into is missing. And recently, there is an FIU direction for all the UPI transaction. You should have the remitter account details, and it is not there. Even NPCI is not having. So this discussion is happening between RBI and NPCI. So all these new payment mechanisms are actually creating a new area where the banks or the institutions are not having the enough information. And secondly, what is getting developed is definitely customer ease of transaction. When an ease of transaction, you discuss with any fintech company, and I need not embark on this further, Anil would reconsider. So the solutions, what we want to offer to the customer, within 10 seconds, 15 seconds, he is opening an account. When I put one additional question, it actually drags 2 minutes, 3 minutes from the system perspective. So the way in which the customer convenience, what we are looking is actually removing lots of controls, which traditionally being inbuilt by the financial institutions. So that is the another challenge. So the real solution, what we look is to fill the dots where this data is lying. That requires governmental and other industry bodies and fintechs cooperation to that extent, and fill up all these dots like small children will be doing in this 1, 2, 3 to finally reaching to the mother or something like that. So that caricature like that exercise needs to be done. So that actually definitely we will look forward the fintech as well as the technological solution.
Extremely interesting points you touched upon, Cyril. Just two follow-ups there. Just given your extensive experience in this space, have you, in your experience, seen FIU and the enforcement arms get a lot more active in the recent past, maybe in anticipation of further incidents, or especially given the digital age, non-physical world we all have been living in the last 15 odd months? And secondly, any FATF misalignment you see from a local law versus global law, and anything that needs to be or should be bridged to ensure that the local laws in India. So is this a question of law or an enforcement is broadly where I'm looking at?
Two aspects. Definitely FIU has become very, very active, definitely, because earlier in a day, I used to do, or in a week, I used to get 2 or 3 account details information they would be asking. Now, at least in a day, we will be getting 10 to 15 requests coming from seeking the information and all. From that is FIU. Apart from that, many government departments and the regulators are also started to seeking it. And because they are getting the big picture from some places, there is something is there, and a lot of these apps, whether it is a gaming app or something, and even I have seen last 6 months, one of the gaming app, some of the escalations have happened and we have started to report it. And 3 months down the line, what we are seeing is, of course, it's all linking to the cryptocurrency. That is, even the normal simple gaming app has been used to finally invest outside India in a cryptocurrency. So FIU is very, very alert. And because of the FATF mutual assessment happening in India, FATF is also setting up more and more ground rules. That is where they have recently said 6 months back, 147 red flags they have identified. Out of that, 90 should be system generated, remaining should be behavioral. And the principle is that you assess the customer history and come back to us. So very, very active FIU at doing that. To your second question, whether there is a misalignment to FATF, yes, two broader areas. I don't want to list out all. Two broader areas is the concept of the politically exposed person, PEP. As far as the Indian regulations are concerned, it is talking about when you have a foreign office only, not any of the Indian office. Of course, India's currency in the corruption level in the international chart, we are not on the right place to that extent. So naturally, what happens to the domestic? And we have seen the money laundering related thing and the funds flowing to whether it is Swiss bank or so, whatever it is. Yes, that could be one of the areas whether necessarily to be looked into. Second area I would say is that sanction area. This is a twin brother to the sanction issues or twin brother to the money laundering issues. And that is one of the biggest problem the international banks are facing. And almost everywhere we have a transactional level sanction screening. But Indian regulation even today says you should do the transaction screening of the onboarding stage and periodically of your client list. It is not talking about a transactional level screening process. That means you are not checking the counterparties, you are not checking the insurer, you are not checking the shipper when the transaction is happening. So these are what the two gaps. And Indian banks are facing this challenge because their correspondent bank overseas is responsible to US authorities and UK authorities are saying, yes, your transaction has got a problem. The same way, the nesting concept, which is there internationally well embedded, is not developed in India to that extent. So these are the three areas I would say. If you ask the question, yes, it is a problem with the legislation. Maybe it's a conscious policy decision, but that is what we are misaligned with the international and FATF concept.
Great, Cyril. So very, very interesting points, and that segues very well into my next question for Anil. Given your global experience with, and also being the non, so to speak, banker or regulator on the panel, what are the threats beyond sanctions? What limitations? How could fintechs contribute? We've been hearing about EU6 directive, its implications. Any thoughts on what solutions could be? I mean, giving the other side perspective to this whole discussion from a filling the gap standpoint, and especially, is this only a sanctions discussion when it comes to financial crime, or there's a lot more to it?
Sure, thanks, Anu. And before that, I'd just like to add on to Sunil's point on the PEPs, the regulators in India versus the FATF guidelines. So, of course, we see some sort of inconsistency over there, but then the risk reference data, like Refinitiv or any other data, so any foreign elected member is a PEP, right? So by default, all the country does get covered. It does benefit all the MNCs. If the banks are MNCs, they will have access to all the PEPs in the world. But of course, if there are local banks and all those, they might not be able to access to that data because then the guideline issue comes into picture. For the questions related to sanctions, definitely sanction is just 1% of the entire risk, but it's the most important risk. It's designated risk and accepted by all the parties with the 1373 resolution. But there are a lot of entities or individuals who are emerging terrorists, but they are not on sanction list, and that could be a very good early warning system, like Bahrum Naim from Indonesia was involved in Jakarta attack in 2016, was there on adverse media for almost 10 years. And it only appeared on sanction post Jakarta attack. So the damage was done. So definitely the risk needs to be evolved beyond sanctions through adverse media, through the native medias, through the local legislation and the PEPs, as Sunil has rightly pointed out. And different countries might have a different approach towards PEPs. Like mayors in India might be a PEP, but mayors of with city like 10,000 people in Australia may not qualify as PEP. So we have to take a holistic call, and I agree it's a collective fight against the financial crime. With representing Refinitiv, we are part of a global coalition to fight financial crime. And that's a public-private coalition along with Europol and World Economic Forum, which brings different players together to fight financial crime. And identify how we can advocate some of the tangible reforms and make global anti-money laundering framework more effective.
Got it, got it. And just to follow up there, Anil, for you before I move into more, I think this part was more about finding the problem. I think would love to discuss what solutions in the next part with each one of you. But are there any basis again, given how uniquely positioned you all are, any particular takeaways basis the global trends you would have seen for regulators or banks which they could borrow, which might be a glaring gap, not a gap, but at least a learning currently.
Yeah. So recently I read something on Swift moving, since we are talking about payments, that being one of the critical areas, and around 80% of the payment from 2022 to 2025, almost 80% would be done through a single platform. So that's not a mandate, but it's a de facto transition by Swift with the logic of ISO 20022. That's a new interface, which would bring in a lot of uniformity in the way we do compliance. So regulators and even the risk reference data are looking more details. So that gives some sort of relief, at least in the payment industry. A lot of entities globally are being issued with the LEIs, where it becomes very easy to track the business records, red flag them a bit more easily. Another important thing is partnership with various forums and various technology, because it's ultimately it's technology. We get a lot of inputs through AI. But from my personal experience and the organization that I represent, human intelligence still tend to be #1 in analyzing and red flags for the financial crime. So AI gives us more data, but then we need more people to analyze it, and people having multiple language skill set, more lean approaches, and which makes it more operationally efficient for the banks as well as for the risk reference data, because there are 2 billion websites in the world, and the risk reference data would be monitoring pretty much everything that has risk or threat. And there's darknet as well, and the new emerging threats like cryptocurrency. For India, of course, we don't have a legislation as of now, but we started monitoring that globally as per the directives globally.
Interesting, very interesting thoughts, Anil. And that takes me to the corrective point I had mentioned about, and this is for Ms. Manorama. There's been a lot of talk of RegTech over the last few years. We've been seeing a lot of useful tools coming up, a lot of activity in the RegTech startup ecosystem in India. So would love to hear from you. What trends would you be seeing? And is this something real, or is this more a word at this stage in terms of benefits? And from a data management standpoint, do you see SEBI, RBI, other regulators playing a role when it comes to RegTech?
Sure, Anu. I think that's a very bang-on question right now, and just wanted to, kind of comment on the follow-up with what the previous panel Anil has commented as well. One of the point which I wanted to add on is about uh, defining these predicate offenses, right? I think it changes from each of the continent, countries, and jurisdiction. I think we have a lot of work to do there. That how are we actually bringing this in scope with regard to the culture each of the country follows, right? For example, environmental crime is not considered as a crime and doesn't come under the bucket of financial crime in most of the countries, right? Thanks to anti-money laundering 6 directive, where the predicate offense scope has been increased, and that enables to enforce a lot of the big networking in the chain, what we call it as, right? The web cob of financial criminals across the countries, across the continents to come under one bucket, right? I think that is a main point, what I see as to how are we scoping out, how are we defining this financial crime, right? Is it more specific to the culture? Is it more specific to what the experience the policymakers had in, historically, and then made up to the scope of defining the potential or a futuristic financial crime predicate offenses? Or we're actually more being realistic and real time in understanding as to what can potentially become a financial crime, right? Today we are talking as and when, and we are catching up with the cyber criminology, or maybe driven by the event like COVID or something else to define it and then scope it out as a financial crime, rather than actually understanding the strategic element of financial crime, which would be what is impacting my economy today. Is a cash flow impacting negatively, and impacting negatively utilization of those resources, creating a false promises in a banking and financial institution, right? I just wanted to add on to that. Coming to the question, what you actually asked now about RegTech, I think it's not a myth. I think we have a lot of work which has been done in the past. A couple of vendors whom I personally worked in my experience as well. There's an element of data management and data lineage, what you just spoke about as well, right? Which also touches upon the regulatory requirements of BCBS and also the GDPR, what we have, where we promise and also we take care from a provision standpoint how the risk aggregators work, how the risk reporting has to be monitored. There is a set of rules, there's a set of principles with each of these regulators have defined from a jurisdiction standpoint, whether it is EU, Asia, or other part of the global jurisdictions, right? I think we have enough of regulations. What RegTech is implementing is condensing them to the data management aspect of it, connecting it to the what are the key parameters of the risk data available in each of the financial institution, just not limiting to the banking organization. We have a lot of small and medium scale financial organizations which are early prawns and early eyes for the financial crime as well. How do we ensure that we are engaging them from a RegTech standpoint, right? In one of my early conversations of previous webinar, I mentioned about supervisory technology, right? Supervisory technology is actually very close, where we are not only thinking about having a fancy dashboard about reporting, but having to attain a very meaningful insights about the data available from each of these financial institutions. For example, if there is asset class which has been defined in XYZ manner, why is the asset class has been defined in such a manner? How is it composing to be a financial crime comparing to the other financial organizations, or even for that matter, the banking organizations, right? We're touching upon the core of actually defining a taxonomy as well when it comes to RegTech, right? I think RegTech is going to be here for long because of that. It's not because the regulators are imposing, it's because the meaningful intervention of data-driven solutions, which helps the financial institutions and banking to translate the preventive measures. And that is a reason why I think RegTechs are looked up to right now. Couple of points there. When we talk about risk data management, not all the regulations impose equally on all the banking organizations. I think we agree on that one. Each of the banking organizations and financial institutions have their own policy and threshold management above and beyond the regulatory impositions what we have today, right? And that is why we don't solely depend on regulatory provisions where we are saying my risk appetite is less because of the regulatory requirement which is enforced in a particular jurisdiction. I think bank is at its autonomy to have more and above that regulatory requirements today. And hence RegTech plays a very important role to harmonize that and say that this is your risk definition, this is your data, and how does this data flow from information from a database where we procure them. What is a single source of truth? Earlier today, I spoke about single source of truth. What would that mean for me from a RegTech standpoint is, do we actually trust all our primary source of data which is available, the golden source of data, right? We spoke about Aadhaar, we spoke about PAN, we spoke about passport. Are we fully sure that they are not manipulated? Right? Are we sure today our biometric solutions actually arrest those details at a very early stage to create a more positive alerts, right? I think RegTech has a lot of solutions when it comes to arresting them at early stage, from defining those data in a database, translating them to more technology-driven language so that the banking and financial institution can talk about it and create more holistic solutions in preventing financial crime. Thank you.
Very, very useful points, Ryan. Two things which I made note of, and I would love to hear from Ms. Theresa on this, is how agile do you feel are banks, financial institutions? Again, given your extensive experience in on the compliance role, in dealing with regulators, both on the supervision and regulatory sides. So how agile, in your experience, would banks and financial institutions be in implementing these RegTech solutions or financial solutions? Are they more reactive today, or are they embracing them at an early stage in creating the necessary architecture, core banking solutions or otherwise, to ensure that they are ahead of the curve when it comes to dealing with evolving types of financial crimes? That's the first one, and especially access to databases, is it helpful? Should that be deepened? So we'd love to get your thoughts, ma'am, on this.
Thank you. Regarding the agility of financial institutions to bring about changes in their systems to tackle new challenges, as Manorama rightly mentioned, each bank has its own particular risk profile, and which is the basic principles of risk management within the bank, knowing its customers, knowing the territories they operate in, the geographies they operate in, whom they do business, whether they have correspondent banking, nested banking relationship, and that shapes the entire risk mapping of a bank. Within that framework, they need to adopt the right technologies which help them to manage the risk. Currently, banks face a challenge of the rapidly changing technological innovations that are taking place, the requirements of technology, and how quickly they are able to adapt to this kind of technology, build in the appropriate technology, is a challenge they are facing. But many banks are adapting to it. And it could be one of the indicators is, though the penalties are increasing, for as you would have seen, the RBI has been imposing penalties on banks and running into crores. But then they are less for AML violations. While in 2018-19, you found around 27 banks being penalized for this. The violations are less on the AML CFT front, but they are more for other violations, like maybe classification, not reporting on the credit platform, and various other regulatory offenses. So it does show that while banks have been coping with the changes regarding the AML, CFT, regarding knowing the threats that it offers to it, how it affects their business, they are catching up on this front, though it requires a huge investment in technology, and which banks generally are very budget conscious on this, and that is where some of the hassles do take place. The other thing I would see is, while from the regulatory point of view, is that there's a lot of developments regarding building up databases. RBI is working towards common databases where information can be pulled out from banks directly, so that it helps them their supervisory initiatives. Banks have access to the fraud platform, common fraud platform, the KYC platforms and others, where they get data on their customers. But as many of you have mentioned, the problem is, where do you get this integration of data? And like in some jurisdictions, you have a complete registry on the beneficial persons, where it may not be so much so that the Companies Act may provide some information. You do not have all the information in India. So how do you pull together? How do you manage to, or you have access to such data? Is the key thing which both key point which both supervisors and banks should address. And one more thing one more trend which I see is that sometimes criminals take advantage of disparity in regulations. While one jurisdiction it is stricter, in the other jurisdiction those laws are not implemented. So they shift based to those institutions, and then there are inflows into the particular institution. Take the case, say, of virtual assets. We do not have a kind of a regulation in place in India, but it is still happening. It happens. There's a huge investment now, and a huge is running, say, the industry, the cryptocurrency economy. In fact, is picking up pace in India. While even the FATF thought some time back that it is really not so much a challenge to financial stability, and because the transactions are few, they have also realized how significant it is now to pay attention to this, because it could threaten your monetary policy if a virtual kind of unregulated transfer mechanism is evolved. It could upset your entire monetary policy predictions. And virtual assets are being used increasingly for great transactions, terror financing. Many of the terrorist attacks have taken place through even Bitcoin funding. And this is something the US Department of Justice just last year broke a syndicate of terrorist financing, which adopted multiple accounts where money was flowing in through Bitcoin sources. And so this is becoming a challenge. And the absence of a regulation in India would pose a threat to us, in the sense that it could be increasingly used as a channel for terrorist financing. And that is something both the government and the regulator needs to bridge, because it would be increasingly being used as long as it's not regulated. In fact, there are signals that it is seeping into the real economy. Recently, I saw how a cooperative bank, Jaipur-based cooperative bank, is extending loans against crypto assets. So if the loans get bad, then it's a risk on the banks. It affects the banks, and it could wipe out, say, financially not so savvy cooperative bank. So these are the challenges, and regulations, technology have to keep a pace ahead, anticipate what the challenges coming in from either virtual assets, changing trends in terrorist financing, which is now, instead of global, go local for funding, trace the financial footprints, and have better technologies to involve. In fact, this is also something which came up after the FinCEN files leak, when it was found that some of the STR's reporting was after 16 months, which is a staggering delay, and which could affect, tracing those transactions. So the Marcus Player, the FATF president, had created a working group of artificial intelligence specialists, banks, financial institutions, technology, and other risk specialists to evolve technologies would help in faster growing up of suspicious transactions, and help in the enforcement agencies take quicker action. Right.
Very useful, Mr. Theresa. And just to follow up question to this before we throw it open to the audience. So typically, we've always been accused as a country where entry-level account opening has been lax. There've been a lot of instances, be it after demonetization, or where it turned out that the person whose account was opened was not really the person. So of course, transaction reporting, monitoring on an ongoing basis is equally important. But do you feel there is scope for tightening at the entry level itself? Because when mistakes get made in account opening, on the KYC, on the and this is a lot more evolved in the Western Hemisphere maybe in terms of account opening. But here the worry has been, somebody who who might be your house help. A lot of practices have come to light in terms of account opening, and when the entry at the entry level, when things KYC is breached, then it gets very difficult to monitor financial crimes. Do you feel there's scope for doing anything to ensure this can be checked or further tightened?
I think as of now, regulations are clearly in place, which require what are the steps to be taken before you open an account. Know your customer through establishing his identity through documents, and having monitoring his transactions, etc. So the regulations are in place, but how effectively you ensure that is the right person who is operating that account could be seen only if you track and monitor the transactions in the account. As you said, say a house help opens, and the pandemic has seen certain instances where people who are out with job, their accounts are being utilized for
Right.
as news. So when you see those transactions in those accounts, that's where technology can throw up those mismatches which is inconsistent with the profile of the customer, and track of those transactions. A housewife, say in Bihar, is shown as having no source of income, but suddenly receiving a huge amount in her account. These are certain signals which need to be red flags, which need to be picked up by the banks, the financial institutions, by effective transaction monitoring. So it depends on one of the golden principles
Right.
is seeing that the initial it's not just the first 3 months or 6 months which is important, but looking across the transactions for a period before you really classify this as high risk, low risk, or medium risk. And your effective classification of risk would depend on a combination of factors like your account KYC data while opening an account, and the second part of it is transaction monitoring and taking quick and effective action if you find that these transactions really do not match the profile of the customer and could be a potential threat to your bank.
Very useful, Ms. Theresa. So we are about to hit our 110 mark. We have a minute to go, and there's a very interesting question from somebody in the audience. I mean, there were a few, but the one which I thought seemed very interesting. And the question is, if the data is outside of the banks, then how can fintechs help? So let me conclude with maybe Anil, based on your experience, whether it's a fair statement to make in the first place, and if yes, what your thoughts would be on the question.
Sure. So I would first say definitely it's a collective fight. It's banks, risk reference data, it's fintech working together to fight the financial crime because it's huge. It has penetrated almost every system. And as Theresa ma'am has rightly pointed out about the instincts, about some signals. So those are few of the skill sets which are required apart from the framework. And of course, a strong ethics with all the banks and financial institutes. That may be of help in a broader sense. Coming back rightly to the question, if the data is outside the financial institutes, fintech definitely could be of a lot of help, as I rightly said. AI, technology, deep learning, those are things of the future, and we've already started reaping benefits, but ultimately it's about the human intelligence that could help us analyze and structure the data that is required and avoid that sort of over-screening for the banking institution.
Brilliant. And Mr. Sunil, any parting thoughts on this? Any last insights on this question?
Yeah, basically, see, the fintech can do a lot. One of the biggest challenges also we need to see. Traditionally, the data was available with the bank, and that is the way people are thinking. Yes, there are lots of other things connected with the secrecy and the personal data protection. All the obligations are there with the bank. Now, the entire data management is not only for the KYC AML space, the entire banking transaction data management is moving to the fintech to a great extent. And they have mechanisms, equipments to analyze in a better way, and everything is there. But there is a risk element to be seen that the data management is moving to that extent, and many of the fintechs are unregulated entities. And my experience in Singapore, we tried actually International Chamber of Commerce or Banking ICC thought when the fintechs are being onboarded at that time, actually international banks and all, we see that it takes 6 months to 1 year for a fintech to be onboarded with a solution. It's a too much long time. By that time, the technology itself will change. So ICC formed a working group to create model rules for the fintechs. And if they are following it, the onboarding by the financial institution can be very fast. But that experiment completely failed because when you create the rules for this technology innovation,
Right.
actually you are killing the innovation on one side. So we need to do a balancing act to that extent. Yes, this risk is there. And that is the way even regulators are also thinking. The compliance perception, the rule-based compliance tick box approach is one side that will continue. But you need to actually think from a
Right.
cyber space, security space, what you need to, and you have to think very forward-looking risk to that extent.
Understood. Ms. Manorama, any parting thoughts? Any comments on this?
You're on mute, I think.
Am I audible now?
Yeah.
Yeah. Thank you. So following
And
up,
I'm being warned, Manorama, we have overshot time. So
yes.
I think we'll start the next session, but anything from you, and then we can close.
No, I think a very quick one is about consent strategy, which I was supposed to be mentioning. I think from a regulatory standpoint, we have a consent management as a part of the regulatory requirements where we obtain a consent of each and every data which can be shared across cross-border as well, which makes it very easy to procure and circulate a data as well, and also a data erasure regulatory requirements where after a stipulated time, the data is erased from fintech as well, which has been procured. So we see no challenge on procuring these data from a fintech. That's all I wanted to mention. Yeah.
Can I just
Great.
mention a point here? Can I have just a point? May
Sure,
I?
Theresa.
Yes.
Sure.
Yeah, just a quick point on this. That today data privacy is gaining a lot of significance, given that in the euro, it's GDPR is there, and in India, of course, the data privacy laws are in the working. But the KYC regulations also prevents or rather restricts circulation or sharing of data, except under certain circumstances. That being the case, customer consent is one thing. The other part of it is when fintechs are allowed to process, say, data for banks. Banks also, while choosing the partnership, they need to see that the same kind of due diligence they perform before onboarding the fintechs to perform the particular function as part of their risk management. And data is secure because ultimately for any breach of data, it is the banks which would be held responsible and accountable for it. So this is this is something which banks need to keep in mind while partnering with fintechs, and that risk management strategy also to see that the like to say the loan apps which happened, fintechs which they partner do not use their the access which they have, the tie-up which they have bank for dubious advantages. Thank you.
Great. Thank you, everyone. This was a brilliant session and personally very insightful and learning to touch upon all these various aspects. Jivisha, over to you.
Thank you, dear panelists, for such an engaging discussion. We appreciate you taking time out to join us today. We would like to thank our session partner, Refinitiv, Gold partner, Reactor, Bronze partner, Onfido, and Knowledge partner, EY. Ladies and gentlemen, we'll be back in 5 minutes with our next session. Stay tuned.
Supported by Invest India and Startup India. Today's panel discussion is one of my favorites, and it's relevant to the current scenario. Financial crime